This video discusses data contained in investment plans. The video is brought to you by PolarisInvesting.com, a site for creating defensible valuations. You are invited to watch other videos on the Polaris Investing YouTube channel, particularly the concepts playlist. As a reminder of how to get to that, one way to get to the YouTube channel is go out to the PolarisInvesting.com site. And over here, Watch and Learn takes you to the Polaris Investing website. Scroll down and you'll see a series of playlists. And playlist that is suggested that you go to here is Concepts. And under the Concepts, you're currently watching the Investment Plans Data video. But it's highly recommended before you watch this video, you at least watch the Investment Plans Overview video. Alright, so back to this welcome screen. I want to point your attention to the graph here that has a straight line that represents valuation over time, and then the oscillating line reflects changing prices. Now obviously prices don't change that predictably, but it's just representing the prices go up and prices go down. So if we look at this price at this time here where we have the red dot where the price is significantly lower than the current valuation that's been calculated, and it's assumed here at this point in time that we've calculated valuation and we've projected that valuation into the future, but we've also discounted it back into the past, and then look at historical price data and then projected future price data. Now what you notice here is that price rarely intersects with your valuation line. That goes with the saying that the average is not norm. That if you feel like over a long enough period of time that the straight line or the linear line on the graph represents on average what you can expect, but prices will move all around that. You can just see that rarely is it normal for the price to align with what you consider to be the average valuation over time. So it's important to be, as an investor, to be patient, waiting for the prices to be significantly below your valuation before purchasing, and then waiting at some future point in time where the prices moved significantly above valuation to sell. And by doing this, you increase your likelihood of above market rates of return, which means that above cost of equity, earn some additional alpha with your return. What is not shown on this graph is another linear line parallel to the theoretical valuation line, referred to as the practical valuation. Now, where it's typically located at is in between the current price and the theoretical valuation. So let's say that you're calculating a valuation at this point here, or right at the red dot, and you calculate valuation. You project it historically. You also project forward in time, and then in between the red dot and this theoretical valuation, you draw another parallel line called the practical valuation. Now the practical valuation line is offset from the price, the current price, the red dot, based on the likelihood of the market changing its opinion about the valuation of the proper valuation of a company, and moving the price towards that valuation. And when there's an extreme difference between price, like we're representing here with the red dot, and the valuation, it's somewhat arrogant on behalf of you, the investor, with your valuation, to think that your valuation is correct and the market is wrong. It could be that you've missed something in your valuation to account for such a substantial difference between the current price and your valuation. So the practical valuation starts from the perspective of the overall market and where the current price is. What's the likely change in opinion that the market could have, really, to the main two drivers of valuation, which is sales growth and the riskiness of future cash flows. And there's only a certain range within a reasonable time or near-term time frame that you can expect the market to really change its attitude or opinion about those two major drivers. So the practical valuation attempts to consider how much of an opinion change you could see in the near term, and then end up with a line that's somewhere in between the price and the theoretical valuation. We'll be discussing this more in the video, but just wanted to briefly go through that from a kind of a pictorial point of view. All right, next we'll shift our attention to the Polaris.com, PolarisInvesting.com website. What I'm currently showing is a ticker, what is known as the ticker page, and showing it for an example company, Kellogg. I'm assuming that the viewer of this video is familiar with this ticker page, that has watched other videos or is a subscriber to the Polaris website and has access to this page on the website. So I'm going to briefly go over it, but I'm again going to assume viewers are already familiar with it. What you're seeing on the ticker page is over here in the middle here, you're showing the theoretical investment return based on the growth slider that's been selected. Now by default, Polaris calculates a default sales growth, and so when you first bring up the ticker page for a company, it's set to, the sales growth is set to that default value, but you as the user can move the sales growth around to whatever value you think is appropriate. Underneath this theoretical investment return is the theoretical value, and then under that is the sales growth, which is just simply, you can see here for theoretical, is the sales growth slider. To the left here, far left, is the investment return that the market, if you assume that the market price is the value, that they're exactly equal, then the investment return you're going to make is the cost of equity, which is in this for Kellogg's is 6.1%. Underneath that is the valuation. Notice the same thing as price, and then the sales growth is implied by working back through the valuation formula. You notice here as you move the slide around, unlike the other values, theoretical and then practical, and we'll be talking about in a second, those will move around, but this market sales growth never moves because it's just implied from the current price. All right, so this middle column is what I was talking about in the graph earlier on the welcome screen. Is just saying it's a parallel line to the theoretical valuation, and it takes into account the likely change in opinion that the market may have from its current price or valuation that it's come up with. So it's somewhere in between the theoretical and the market. And so you end up with a investment return, practical investment return, practical valuation, and then a sales growth that is built into that practical valuation. Some additional information that I want to make sure you're aware of is down here at the bottom under the company information. You have things like projected future profit margin, future PE. You have the historical profit margin, historical PE, and cost of equity, 6.1%. The same thing as this investment return, if you the market investment return. And so when you when you decide you're ready to go and lock in, you've set the slider to where you feel like represents what, and I'm going to leave it at default. But once you decided on the sales growth that you're going to go forward with, well, since this video was originally recorded, there are two additional sliders that you also can set before you lock in and make it part of your plan, namely the profit margin slider and the price earnings slider. You're ready to lock in this practical investment return as a target return that you're going to create a plan around. So you just now click on Add to Plan, and then you come over here and look at your investment plan. So what we've done here is on today we've created a plan around Kellogg's. The target return is that practical investment return of 9%. The price at the date that we saved the plan was $56.79. Today's price, which is the same because it's these prices are the same because today is the day that I created the plan. But in the future, this current price will change. The status is a buy, sell, or watch, or which means wait. And it's based on these thresholds that are automatically calculated for you around the start price. So you can see here that the buy of 50 is right around 56.79. There's a high side of that range, a low side of that range, and then on the extreme sides of buying are watch bands or thresholds, and eventually extreme depressed price where it would be recommended that you sell, or there could be an extremely high price reached. Now these thresholds do change with time, so as you come back and review your investment plan, the recommendation of buy, sell, or watch will change based on a reassessment of valuation and the current price that you may be at. Everything I've discussed up till now has been pretty much summary information. More detailed information is contained in the initial overview video on investment plans. So I'm going to now scroll over here to the right, talk about some data fields that haven't been discussed in other videos. You can see here that one of the data points that's captured with your investment plan is the theoretical valuation from the ticker page, the practical valuation, the market sales growth, the default sales growth, and then the slider sales growth, which is 11%. Now make sure you know which values we're referring to here. I'm going to go back to the ticker page, and you can see here that the 4% market investment return is shown here to the left, and then the default sales growth is here. The slider value is 11% is shown here, and when we save those off in your investment plan, the main reason is that it gives you an idea of what other values were suggested to you when you eventually decided on 11%, namely the default sales growth, and then what the market seemed to be implying through the based on the current price. All right, scrolling more over to the right, we see that there's the share growth is captured, the future projected profit margin, projected price earnings multiple, current sales, the current shares, the current profit margin, the current price earnings multiple, the dividend yield, which is the dividend divided by the start price. So that dividend yield does not change over time. It's just what it's captured as to what it was at the time you saved the plan off. And then the cost of equity is saved as the last value. Well, since this video was originally recorded, 6 additional values are being stored with a plan, starting with this profit margin growth and extending over here to the future risk-free rate of return. The profit margin growth reflects the change in profit margin between stage 1, or the current profit margin, and then what's being assumed in going 5 years later into stage 2. With the slider now being added for profit margin, the future profit margin is now clearly shown under the profit margin, the future profit margin slider. Before, it was down in the company information section. Now the earnings growth is based on the profit margin growth, and there's a formula for calculating based on the sales growth slider value, and now the profit margin slider. There's a formula that can be used to determine the earnings growth, so it's shown here. And then the remaining 4 values that have been added have to do with the PE multiple, and the PE multiple is now a slider, but it used to be just displayed down in the company information section. So these values pertain to the old video as well as the new updated version of Polaris. The source value of the future R is the return on projects that's implied by the future PE value. The future cost of equity, that's just the same value that's displayed down in the company information section. And it's just allowing you to compare the future R with the future expected return from the market. And in this case, the profit margin, the PE multiple, has not been changed from that regressed future PE number. So those two numbers are the same. But if the user were to move the slider around for PE, those would be different. And you want to compare to see if, or compare it to the cost of equity to see if being reasonable about what kind of return a company could make into the future forevermore. The next value is the future earnings growth, and that's assuming a mature company typically has 33% or a third of their earnings are reinvested. So growth of earnings is simply the return that's being expected on projects times the reinvestment rate. So if you were to just take 1/3 of 5.6, you get 1.9 is where that number comes from. And then the future risk-free rate of return is just the number that Polaris uses in various calculations. But it's shown here because it's also a typical value that's used for expected growth in the overall economy. So 2.5% growth in the economy, you compare it to what growth you're assuming here for earnings, and typically a mature company wouldn't be expected to grow much more than the growth in the economy. But if you move the PE slider up quite a bit, you could end up with a future earnings growth at much more than the growth in the economy. Then you just need to think through whether that kind of growth for this company is realistic or not. Now, the main reason for showing these kind of detailed values along with the plan that's been saved off is all about transparency, so that you, as the end user of the PolarisInvesting.com website, if you choose to go back and want to validate the calculation of practical valuation, theoretical valuation, investment returns, whatever you want to validate, it's total transparency in terms of how the values were arrived at. So let's take a look at the formula, assuming that is what you're interested in doing. And as a reminder, and these are discussed, the formula is discussed in more detail in the concept videos, which I invite you to go out there and watch. But as a reminder, you know, anytime you calculate valuation, whether it be theoretical or practical valuation, or even if you want to reverse engineer maybe a value, you could set valuation equal to the current price, and then let's say that you wondering about maybe what the market's implying about what future sales could be, you could go ahead and use the Polaris derived values for profit margin, PE, shares, and cost of equity, dividend, and then work backwards and figure out what future sales must be implied by the current price. But let's go through the formula, and you can see here at the beginning of the formula you have future sales times future profit margin, which when you multiply that two together, you get a future earnings. And then when you multiply that by future price per earnings, you end up with a future price. You divide that by number of shares that are anticipated to be outstanding in the future, which for Polaris, the future is always 5 years. And then you discount that back at the cost of equity for 5 years, and then over the 5 years you earn dividends, so you go ahead and add in 5 years worth of dividends, and that becomes your valuation. Now I want to digress this for a second and have you consider, what if you knew the current price earnings ratio, the correct PE, not just the calculated where you go out to like Yahoo site and see what the current price is divided by most recent annual earnings that have been reported. But let's say you came to the conclusion of what a correct PE for valuation should be right now. Well, what you could do then is you could just take the current profit margin times the current sales, and you could end up with a current valuation. There would be, and then divided by the number of shares. There'd be no reason to discount back in time, because you're sitting here at time right now, time 0, and then there would be no dividends received. So you'd end up with a fairly straightforward calculation, but the problem obviously is that you don't know the correct PE. So the whole purpose of the Polaris valuation is to move forward and to move to a time in the future where you feel like you have a better understanding of what the PE is likely to be. And that period, again, is 5 years in the future is what Polaris uses, and it assumes in 5 years a company's return on its projects will mean revert to its cost of equity. Again, there's other videos that go into that in detail, but that's why we move forward in time to get to a known PE. Well, then you multiply it by a future profit margin, which isn't that difficult to project. You look at what industry standards are, what the current profit margin for a company is, and you can make some assessments, reasonable assessments about what likely future profit margin is going to be. But then you need to provide what future sales are going to be, and that's really where the complexity, or you've shifted from now having to know what the current PE is to a mean reverted future PE. But you've now shifted the need to think through what likely future sales might be. And future sales is just simply current sales times some expected growth rate. So that's why on the PolarisInvesting.com site, the main input that the user provides through that slider is the growth, your expected growth. Polaris defaults to a value. You can compare that to what the market is implying in the current price, but then it's up to you, the user, to decide what you feel like is a reasonable growth in sales that you can assume. Now, sales and growth is a difficult thing to forecast, but it is relatively more straightforward than trying to forecast many other values like a PE or future earnings. You can at least look at what addressable market there is out there. How much of the market do you think this company is going to be able to capture, and in order to create a future defensible sales. All right, with that background on the valuation formula, let's go out for Kellogg's and look at the values that are provided and see how we would actually calculate the theoretical valuation. So you would take future sales. Again, the sales slider is shown here, 11%. So you take 1.11 to the 5th power, and that would give you the growth over the next 5 years. You multiply it by the current sales, so that would give you future sales. You take that and multiply it by the future profit margin, gives you future earnings. Multiply that by the mean reverted future price earnings multiple, and that gives you a future price, or really it gives you a future market cap, and then you divide that by the number of shares that you think are going to be outstanding. So here's the current shares, and then over here is the shares growth that's being assumed. So you take 1 plus minus 0.4% to the 5th power, multiply it by the number of current shares. So then you take that resulting number and divide it, include it in the calculation, and you end up with number of or price per share that you expect in the future. Then you discount it back based on the cost of equity, which is shown over here. So you take 1.061 to the 5th and use that as your what you divide back or discount back to the present. And then you finish up by taking 5 times the number of your dividend. Your dividend is the dividend rate times the current price. So to go back to the formula, you can see what we did here. Well, once you've validated the theoretical valuation, next thing most people are interested in validating is the investment return that's been calculated. So next shown here is how Polaris calculates investment return. It assumes that in 5 years things mean revert, and that also means that the market will eventually catch up with, in terms of its pricing, will catch up with the valuation in 5 years. And it's not saying that initially will stay there, but we're just assuming in 5 years there will be a point where the price and the valuation equal. So that means that if you take the current price and you assume some investor return on investment and take that out for 5 years, it will equal the valuation, current valuation, moved forward in time by 5 years, but by its cost of equity. Well, you do the algebra here, and you end up with an expression or formula for the investor's return on investment based on the current valuation divided by the price, and then take it times what you see here in the rest of the calculation. Now, if you go look at the investment plan, and we just went through how you would calculate the theoretical investment return, and you go looking for the theoretical investment return, you'll notice that it's not actually saved off. Because this assumes if you're interested in that, you can recalculate it based on the values that we just, in the formula that we just went through. What you might be interested though is validating the target return. Now remember, the target return is based on practical valuation, and therefore it's the practical investment return. So to calculate the target investment return, we just simply take the practical valuation. Right, let's go bring the formula up. You take the practical valuation divided by the current price, cost of equity, and then you end up with the 9% target return. Well, now the question probably comes up, well, how did you get practical valuation? The calculation of the practical valuation is a fairly involved proprietary algorithm, but it is a fairly straightforward concept. In this table here, is a discrete values that represent risk, actually the beta for those who are watched other videos, but at the end of the day it's a form of risk. And then here on the y-axis you have sales growth, and then mapped into these different valuations based on what risk you're assuming and sales growth you're assuming is the current price, which is mapped here at 53.75, and then the current theoretical valuation mapped here at 72.83. Now the price and valuation don't map perfectly in because you are using discrete values as opposed to continuous values in the x and y axis, so you map it in best you can. But you can see here that we've got quite a disparity between the market price and therefore what's implied in that price of a beta of 0.7 and a growth of 4% versus the theoretical value's got a beta of 0.7 but a growth of 12%. So going back to the welcome screen, you know, we showed here that we have this theoretical valuation line. We have a price, and what we've got is pretty much where this red dot is, a price far below the current theoretical valuation. So it would be somewhat arrogant to move forward with purely the theoretical valuation, to think that you have some unique insight that is significantly different from the overall market. And so it's probably best to, when you have large discrepancies between current price and valuation, is to temper your valuation somewhat by considering what the market's willingness is to change their opinion about riskiness of future cash flows and likely sales growth going forward. So if we go back to this table, we start off here at 53.75. We know that we'd like to get closer to the theoretical valuation, but it's more a question again about what's the market's willingness to change, not how much you're willing to change your valuation, but how much do you think the market could change its opinion, and therefore in a near term change its a price to a value that's more in line with your valuation. Well, the way you do that is you just look at, well, they could change their opinion about risk. It either could go up or down. They could change their opinion about sales growth, but within limits. And so you try to extend the limits to the point where you get as close as you feel like you can to your theoretical value. In this case, I feel like, if you extend closer in terms of growth, you can maybe assume that the market in the near term could get to an 8% sales growth. They may be willing to drop their perceived riskiness of future cash flows down to a 5% or 0.5 beta, and that would result in a practical valuation of $64.82. Well, viewing the two different drivers of valuation, you can see here that these different valuation calculations that are shown in the table, that the valuations primarily change from sales growth reassessment or changes in sales growth, not as much from reassessment of risk, because the range of risk reassessment is relatively narrow, whereas the sales growth differences really account for the major change in reassessment or valuation. So we're going to focus now on just changing the sales growth. Well, if you go back and look at the formula for investment return that we were talking about earlier, if the valuation that you use in the calculation, if you were to assume that you're not going to take into account dividends, and that's by setting your dividend essentially to zero, you simplify the valuation formula even more. But that simplification, you do lose some detail and become a little more of a estimate. But assuming a dividend of zero, which again the majority of the valuation is up here in the first factor of the formula, so it's not a big change in valuation by just assuming a zero dividend. But if you do assume a zero dividend and recalculate theoretical and practical valuation, you'll notice that the formula down here becomes simpler. And without going into the detail, let's leave it to you to go through the algebra. You can prove that the investor's investment return is equal to the cost of equity plus the difference in the market's or the investor's slider value of growth, sales growth, minus the market's implied sales growth. And then you rearrange some terms, and you end up with the growth of the investor equal to the investment return, and then plus the market's sales growth estimate minus the cost of equity. Well, this last formula here is pretty important because it allows you a very easy way to determine what the growth is based on a practical investment return. So let's go back and look at the table here. Calculate this 8% without actually doing the complex math that's really behind it. You can just estimate it by using that formula. So let's go back to the ticker page where we can see this clearly. Is that if you're wanting to estimate this practical sales growth, all you need to do is go over here to the market and take the market's sales growth, subtract off the cost of capital, which is 6.1%. That's a negative 2.1%, and then add that to the practical investment return, and that gives you roughly the practical sales growth of 8%. So let's do that again. That's minus 2.1%, add 9%. That's roughly 8%. So now let's go back to the investment plan and do it here in the investment plan. You would take the target return. You would then come over here to and add the market sales or the market sales growth of 4%, and then subtract from that the cost of equity, and then that would give you roughly 8% for your practical sales growth. And once you have that, you would just go back into the formula to calculate valuation, calculate your future sales based on that sales growth, future and I'm not going to go through all that, but then you end up with a practical valuation. All right, so let's kind of wrap things up. Well, at the end of the day, what is investment plans really providing you? Well, the main purpose is to provide you with trading guidance in terms of these statuses: buy, sell, watch. But if you're interested, it also allows full transparency in how all the calculations were derived. And since this video was originally recorded, 6 additional values have been added. 2 of them, profit margin growth and earnings growth, let you think through whether the slider value for profit margin growth is at a realistic value, results in a sustainable earnings growth forevermore into stage 2. And the last 4 values that have been added let you think through a little bit more regarding future PE multiple and whether it's been set to a realistic value. For more information regarding the use of these values to do a PE sanity check, see the Infrequent Sustained Abnormality video blog around the 50-minute mark. For an even deeper dive into the PE multiple, see the Valuation Calculation PE multiple video in the Valuation Calculation playlist. For more discussion on validating the PE multiple, watch starting at the 25-minute mark. So I hope this video achieved its goal of full transparency. Thanks.